Hello, this is Compound Interest Stock Guide. Today in this video I'm going to be talking about how I played Apple, AAPL, Apple, a 1.4 trillion, 1.2 trillion now market cap company in technology, how I played options on puts and on calls. So stay tuned. If you're new to the channel, don't be shy, subscribe. It's in that right on the bottom of the videos. Make sure you hit that thumbs up. I really do truly appreciate that. Just takes a few seconds. Boom. And leave a comment down below. Let me know what you're thinking. I also want to disclose I'm not a financial advisor. This is just for entertainment information purposes. Do not buy or sell based on anything I talk about. Buy or sell after you do your own research, due diligence, and you like the investments you're pursuing. Okay, so I also want to say that coming up on Sunday, when I'm going to upload this video, but I'm going to be doing the live stream on Sunday night at about 5:30 p.m. Pacific Standard Time, or 6 p.m. Pacific Standard Time, or 8:30 Eastern Standard Time, 9 p.m. Eastern Standard Time. So if you are subscribed and hit the notification, it'll let you know when I'm live. And I usually been doing these live streams for about 1 to 2 hours, so you know, a lot of time to talk. So if you're on Twitter at Compound Stock 13, I'll link it as well, so you can join there. Anyways, let's get into this video. So AAPL. Okay, so there's been a lot of volatility in the broader market on the S&P 500, which is the top 500 companies that are profitable, and that's the SPY. So it's been very volatile based on the negative news, as well as companies aren't gonna have as good revenues, so that's getting priced into the market. But the whole extent of the pricing in my opinion, hasn't been priced in to the earnings. It's basically being pumped up with massive liquidity from lowering interest rates. That what that really does is it makes people want to buy stocks instead of having money into bonds, because a bond is a competitor to stocks in a sense. Basically, if you have if you get in say like a 3% or a 5% yield for say 5 to 10 years, well, that's pretty decent, right? And then but now it's like 0.7% for a 10-year yield, so it's not very enticing to be in a bond. So especially when inflation's a lot higher than 2-3%. So what happens is that then all these stocks, the money wants to go into stocks, as well as the Woodrow. That's what Greg Manarino says is basically when the Fed starts purchasing a bunch of these Apple, Microsoft, Google, Amazon stocks and just pumps them up. Sometimes the crude is running as well. But at the end of the day on Friday, on Apple, it was going up and crude wasn't really coming up. Like, it had kind of had a bottom, so there was kind of some momentum in crude, but nothing crazy. And it was pretty impressive, the amount of the pump that happened because of that. Because you got to look at it okay, if Apple's trading at close to $290 and its all-time high is about $330, and the price of oil's at about $41.60, and every time when I'm trading during the day, any 25-50 cent things that move with the crude up or down has a big effect on the price of Apple going up or down. It's pretty crazy. But then when it was $330, the amount of price when crude was at say $55 down to what it is now, that's $14, right? Based on the amount of moves that happen in the day-to-day on the crude, based on that, the price of Apple should be at $240, $230, way lower. But they're obviously manipulating it and buying, so whatever the case, that it's definitely very important for them to keep up Apple because it makes a big part of the S&P 500. Yeah, I don't know whether it's like 4 or 5%, but you look at the market cap of Google, Amazon, and that's Microsoft. Those are all like added together about $5 trillion in market cap. So that's a very high stake in the S&P 500. So when those stocks go down, then the SPY really goes down. So anyways, let's get into this, how I played it. Apple was trading around about, let's just say 285, 283 to 290-ish. That's pretty much the range. It gapped down in the bottom, based on just some bad data and price of oil kind of going down throughout the day and in the morning before the opening. So that really pushed the price of Apple down, and then it kind of still kept up, and it did all right even though oil was doing good. So it just didn't make a lot of sense. As well as the bonds. The bonds were really getting crushed. They were getting down to like 0.7%. It was the first day that the 10-year was below 1% yield. That's a very big, it's a recession signal. Yeah, it's very interesting. So that was really getting crushed. So basically, whenever I saw, what I did is I did 3 trades throughout the day on Apple. I saw Apple go from 280 to like 287 or something like that, and I would do it on the 1 hour and the 5 and the 1 minute candles. So that I could see the momentum when it kind of hit the top of the Bollinger Band. Then I would enter. Obviously looking at say like 5 days and the 15 and the 30 minutes candles as well, to have a better sense of the direction, as well as checking out the price of crude. So those were my indicators to play the game. I'm becoming fairly sophisticated in my candlestick reading, but that's what I was doing when there was like a red doji from a green candles, like a pattern, and then I saw the green turn to red and change direction. Then I was, especially when I was outside of the Bollingers, then I was really, I put the put on. Throughout those day, I did $70 in net profits, excluding commissions, right? The commissions crushed me. I did one trade. So one trade, I made $45 USD, and then the other one, it was $25. So the one I did was like a 240 put for March 13th, and when it went from like, I bought it from like 245, and then I sold it at 290, I believe. It was either that or the other with my call, and it was like 230 or something like that, and I sold it for like 255. Like, it was something that I made 25 net dollars, not net but gross revenue, I mean, from the options. And then I did the third trade, which wasn't very intelligent, and I did the call for like 302.5 till March 13th, and that could be a very explosive type of trade, but I didn't want to hold it over the weekend based on data not making sense. I'm being very strict with my options because I want to be a profitable options trader, and so if I hold an option and the trade goes against me, that's not very good. So when I'm seeing, like, it was at 215 I bought it for, and it went down to about like 170, and I was waiting for it to go back to like 240, but I mean it did get to about 230, and I would have made $15 gross revenue, and then exclude the commissions, still a loss. But regardless, that's what I was doing, and I sold it at 215, so it was a neutral on that. So I made 2 net gains minus the commissions, and then I did a 1 neutral trade throughout the day on the options with Apple. the whole scheme of things, like I didn't get into these trades to just make $25 or $45, but the whole psychology behind it is that you need to conserve that cash in your options account, right? You don't want to blow it up. Like say you have $500 in your options account, you don't want to slowly lower that balance. So I'm trying to keep it, because when a really good opportunity is going to arise, when say it starts getting really bearish, then I can I can have a position that I can have for like say $150, $250, and that'll turn into potentially like $700, $800, $1,000 within like 1 to 2 days, right? So you're not going to win every trade in options, but the big thing is to ensure you don't lose. Look, options aren't for everybody, and if you're very wealthy, you can sell premium as well. People can sell uncovered calls. I don't do that. In TD, it doesn't let me sell uncovered calls. It lets me sell covered calls. So, I mean, whatever that means is I think that you need to have those stocks in order. So say like for Apple, I'm essentially, when I did those 3 contracts, each contract is worth about $29,000 in $29,000 or to like $32,000 of potential stock in the company. So you really hold a lot of the power behind it, but it's only for a short amount of time, and the price of it really can go up or down a lot in a short amount of time. So you really need to be strategic in getting in and getting out. But anyways, that's just a short synopsis on how I traded with Apple. It was like a net positive gain, like $3 or something like that USD. But I'm just sharing that the potential is there. When the stock will go to potentially say like $2.99, and then I see a red candle and it's going to go down to like $2.60, then I can snipe it and get like a $2.70 or a $2.30 put for like 1 to 2 weeks and make some pretty decent cash. So anyways, I'm just sharing my strategy that is getting locked and loaded into my precision in my trading. So anyways, keep compounding your info, listen to my lingo, and shaka, peace. I'm out. Thanks for watching. Thanks for listening. I got more upcoming stuff in the future days and weeks. So peace. I'm out.